But China is a different story. A 10% tariff on Chinese imports went into effect at midnight. China retaliated immediately. A 15% tax on U.S. coal, 10% on U.S. crude oil, and large displacement cars.
Yes, again, going exactly by the playbook like clockwork. At 1 p.m., seconds after that, China released its slew of countermeasures, pretty extensive this time round compared to the previous round in February. They're targeting up to 15% tariffs on a list of U.S. goods.
In just 6 months, Tesla's market capitalization plummeted by more than 50%, a staggering $800 billion in lost value. This isn't just a loss for an electric car company. This is a loss on the scale of any major corporation, making it a monumental economic event. For years, Tesla was the shining example of success in the electric vehicle, EV sector, and the market treated it as one of the greatest success stories of the 21st century. Elon Musk's brainchild, Tesla, was once unstoppable, a leader in green technology and innovation. But in 2024, Tesla has faced a monumental crisis that has shaken not only investors, but the entire global automotive industry. Let's break it down. Over a span of a few days, Tesla's stock tumbled by 15% in a single day, followed by another 3% drop after hours. It's safe to say that Tesla's once unshakable position has crumbled, and its investors are now left wondering what went wrong. But what caused this sudden downfall? At the core of Tesla's problems are rising production costs, declining demand, and increasing competition. To understand why Tesla is in turmoil, we must first look at its relationship with China, the world's largest EV market. Tesla's fortunes in China were once crucial to its success, but now, China's shifting policies are increasingly harming Tesla's position. As part of a retaliatory move against U.S. tariffs, China has raised the import tax on Tesla's products from 15% to 25% on its high-end models, including the Model S and Model X. These tax increases may not seem like much at first glance, but for a company like Tesla that imports parts from the US and Europe, these additional costs are significant. For consumers, the higher import taxes make Tesla cars more expensive and less accessible in the Chinese market, which has long been one of Tesla's most profitable regions. What's more concerning is that Chinese manufacturers, such as BYD and NIO, are rapidly gaining ground in the EV market. By offering comparable technology at significantly lower prices, these brands are making it harder for Tesla to retain its market share. For instance, BYD's electric vehicles cost about $30,000, while a Tesla Model 3 is priced at around $43,000. For the average Chinese consumer, this price difference is hard to overlook. In 2023, BYD sold over 2.7 million vehicles, capturing 35% of the Chinese EV market, while Tesla's sales in China plummeted to only 600,000 vehicles. This shift in consumer preference is a clear signal. Domestic options are increasingly favored over foreign imports. Tesla is not just facing competition in China, but its share in the US market has also been declining. In 2020, Tesla held 79% of the electric vehicle market in the US, but by 2023, that number had dropped to 62.4%, a sharp decline. Elon Musk's controversial political views and statements have played a role in eroding Tesla's customer loyalty, especially among more politically neutral buyers. As a result, Tesla's image as the pioneer of innovation is starting to fade, and competitors are slowly but steadily claiming the market Tesla once dominated. The company's financial reports also paint a grim picture. With production costs increasing and demand shrinking, Tesla faces the hard truth. It may no longer be the cash cow investors once believed it to be. As it stands, Tesla's future is uncertain, and unless it adjusts its pricing strategy and improves its technology, it may very well lose its position as a leader in the electric vehicle sector. Now, let's focus on China, the world's second-largest economy and the primary architect behind the shift away from US economic dominance. Over the past few years, China has been strategically positioning itself to challenge America's grip on the global financial system. While Tesla struggles, China's economy has been growing stronger and more assertive on the world stage, thanks to a series of bold and calculated moves. One of the major moves was China's response to the U.S. trade tariffs. In 2024, the U.S. imposed a 10% tariff on Chinese imports, targeting a wide array of products. China's retaliation was swift and strategic. China imposed a 15% tariff on U.S. coal and crude oil, as well as a 10% tax on large displacement cars and pickup trucks, many of which are made by American manufacturers, such as Ford and General Motors. But the real damage to Tesla came in the form of the increased import taxes on electric vehicles, EVs. China raised its tax on foreign electric cars from 15% to 25%. This meant that the cost of Tesla's high-end models, such as the Model S and Model X, became significantly more expensive for Chinese consumers. At a time when China is investing heavily in its own EV market, this shift is critical. BYD and NIO, two Chinese automakers, are flooding the market with cheaper, more accessible EVs that rival Tesla's offerings in terms of technology and features. In 2023, BYD sold 2.7 million vehicles, which represents a 35% share of the Chinese EV market. On the other hand, Tesla's sales in China dropped drastically to just 600,000 vehicles, a shocking decrease that highlights the growing preference for local manufacturers over foreign imports. But China's tariffs and taxes are just one part of the equation. China has also been actively working to reduce its dependence on the US dollar, signaling a broader strategy to reshape the global financial system. As part of its efforts to create an economic environment less reliant on American financial power, China has been actively building its gold reserves, reducing its US Treasury bond holdings, and creating a financial ecosystem where it can bypass the dollar and make transactions in yuan or gold. China's strategy is clear: reduce reliance on Western financial systems, challenge the dominance of the US dollar, and ensure that its economy is not vulnerable to future US sanctions or economic pressures. As the BRICS nations, including Brazil, Russia, India, and South Africa, align themselves with China's strategy, the foundation of the global economic order is shifting. In early 2025, former President Donald Trump issued an unprecedented warning to the BRICS nations. If they continue to bypass the US dollar in international transactions, they will face a 100% tariff on their goods. This threat reflects Trump's desperate attempt to preserve the dominance of the US dollar, which has been the cornerstone of the American financial system for decades. But his words are not just empty rhetoric. They highlight the growing concerns over the future of the dollar and its role as the world's reserve currency. For years, the US dollar has been the global reserve currency, meaning most international trade is conducted in dollars. This arrangement has allowed the US to borrow money easily and maintain control over international financial systems. But now China and the BRICS nations are taking steps to wean themselves off the dollar and reduce their reliance on it. China has been particularly aggressive in this effort. As we've already discussed, China has reduced its holdings of US Treasury bonds and has been accumulating gold at an alarming rate. In 2024, China added 250 tons of gold to its reserves, signaling a shift away from US dollar-backed assets. This is a bold move by China, which historically has been one of the largest buyers of US debt. The problem for the US is that as countries like China, Russia, and other BRICS members increase their gold reserves and seek to trade in their own currencies, the US dollar's dominance is no longer guaranteed. If the US loses its position as the world's reserve currency, it could face higher borrowing costs, reduced economic influence, and a loss of financial power in international markets. This shift is not just a theoretical scenario, it's happening right now. And as BRICS nations push forward with plans to bypass the US dollar, it remains to be seen whether Trump's threats can prevent this seismic shift in global financial power. Now let's explore one of the most intriguing questions of all. Can gold replace the US dollar as the dominant currency in global trade? For centuries, gold has been the ultimate store of value. In a world where the US dollar's dominance is increasingly being questioned, could gold make a comeback as the primary asset used for international transactions? As we've already seen, China has been steadily increasing its gold reserves. In 2024, China added 250 tons of gold to its stockpile, a strategic move designed to reduce the country's reliance on the US dollar and strengthen its position in the global economy. But China isn't the only player in this game. Other BRICS nations, such as Russia, Brazil, and India, have also been building their gold reserves, signaling a shift away from the dollar and a potential future where gold becomes the new standard for global trade. Why gold? Unlike fiat currencies, which can be printed at will, gold has inherent value and is seen as a safe haven during times of financial instability. As countries like China and Russia diversify their reserves, they are reducing their exposure to US dollar fluctuations and financial sanctions. This could lead to a future where gold-backed currencies replace the US dollar in international trade. If gold does replace the dollar as the global reserve currency, the implications for the US economy would be profound. America's borrowing power would be severely restricted, and its ability to control global trade would diminish. Countries like China and Russia are already leading the charge in creating a new global financial system, one that is less reliant on the US dollar and more focused on tangible assets like gold. The shift towards gold isn't just a reaction to US policies. It's a long-term strategy to protect these countries from the volatility of the global financial system. And as BRICS nations continue to accumulate gold, we may be on the cusp of a new era in global finance, one where the US dollar no longer reigns supreme. As the battle for global financial dominance rages on, the US is increasingly engaging in economic warfare with its own allies and adversaries. The latest developments reflect how America's trade policies, aimed at protecting national interests, are having unintended consequences, creating ripples across industries that are heavily dependent on international trade. One such case involves the Trump administration's plan to impose heavy fees on China-linked vessels. This proposal is intended to revitalize the U.S. shipbuilding industry by penalizing foreign-built Chinese vessels. The idea is to encourage American shipbuilding, which has seen a sharp decline in recent years. However, this initiative, while seemingly strategic, threatens to hurt key sectors in the U.S. maritime industry and other essential industries that depend on international shipping. The Trump administration's proposal would impose fees up to $3 million per U.S. port call for Chinese ships. While aimed at reducing China's dominance in global shipping and boosting domestic shipbuilding, it has created tension within the U.S. maritime industry. Industry executives argue that these fees would lead to higher costs for U.S.-owned shipping companies and disrupt the operations of critical U.S. sectors such as agriculture, manufacturing, and mining, which rely heavily on efficient shipping routes to deliver goods domestically and internationally. The proposed fees are already creating uncertainty for U.S. exporters, with some industries struggling to secure shipping slots beyond May 2025. Agricultural exporters, in particular, are finding it difficult to book cargo space, and coal producers are facing similar challenges. Maritime and agricultural industries warn that these fees could lead to a reduction in exports, loss of jobs, and higher prices for American consumers. A study conducted by industry groups predicts that the U.S. could see a 12% drop in exports, reducing the GDP by 0.25%. While the U.S. aims to bolster its own shipbuilding capacity, the reality is that many domestic companies, such as Seaboard Marine, rely on China-built vessels. Penalizing these vessels could inadvertently harm the very businesses that would drive demand for U.S.-built ships in the future. The U.S. maritime industry, along with various sectors relying on international trade, is facing a double-edged sword. The push for national production and protectionism comes at the cost of immediate economic disruption. If this proposal moves forward, it could disrupt U.S. market access, raise costs, and cause broader economic instability, all in the name of countering China's growing commercial and military influence. As the world's economic superpower, the United States has always wielded trade restrictions as a weapon. Recently, the U.S. has expanded its export blacklist, targeting dozens of Chinese entities involved in sectors such as technology, defense, and sensitive infrastructure. These entities have been added to the U.S. export restriction list, making it difficult for American companies to sell crucial technology or products to these Chinese firms. On March 25, 2025, the U.S. added multiple Chinese entities to its export restriction list, which severely limits the ability of U.S. companies to conduct business with these firms. This is part of a broader strategy to restrict China's access to American technology and intelligence. The expansion of these restrictions has further strained the U.S.-China relations. The U.S. government justifies these moves as a national security measure, citing concerns over intellectual property theft and the militarization of Chinese tech firms. However, these actions have major implications for U.S. businesses that rely on Chinese partnerships. By cutting off access to U.S. technology, these restrictions are impacting the global supply chain, especially in industries such as semiconductors, artificial intelligence, and telecommunications. U.S. companies may find themselves at a disadvantage, unable to access Chinese markets or suppliers that are critical to their operations. Companies like Intel, Qualcomm, and Boeing are already feeling the pinch as these restrictions are disrupting their supply chains and limiting their ability to compete globally. The U.S. government's decision to blacklist these entities is not without significant economic consequences. The export restrictions are just the latest chapter in the ongoing economic battle between the U.S. and China. While the U.S. government claims that these measures are necessary to safeguard national security, they are likely to have severe ramifications for U.S. tech giants and industries that depend on access to Chinese manufacturing and supply chains. The world is changing, and so is the balance of economic power. Will the U.S. dollar remain the dominant force, or will China and its allies succeed in building a new financial order? As we continue to watch this unfolding drama, the global economy could be on the verge of a historic transformation. Stay tuned, as the future of finance is being written today.